Right, welcome to part 2 of lecture 12-A, talking about partnerships. So we've just talked about how withdrawals are accounted for in essentially the exact same way as they would be under sole proprietorship. Okay, so let's take an example and try and work through some of the numbers on how we might do some of this accounting. So let's look at Abel and Baker and their beginning capital balances of $10,000 and $8,000. They don't have a spelled out agreement in their partnership agreement on how to share profits and losses. So first month the partnership lost $4,000. How much goes to Abel? How much goes to Baker? All right. So requirement number 1. Well, remember, legally, if they don't have a formula for sharing profits or losses, legally they're shared equally. In this case, with two partners, it's 50-50 or half-half. So Abel gets $2,000 of the loss, and Baker gets $2,000, and that's how we allocate the loss of $4,000. So if they withdrew no assets, let's take a look at their capital balances. How would this sort of work? So capital dash Abel T account, capital dash Baker T account. So Abel started out with $10,000 balance in his or her capital account, and Baker had $8,000. $2,000 loss is a debit, and so at the end of the period, Abel has an $8,000 balance and Baker has a $6,000 balance. That was requirement number 2. Okay, let's look at a little bit more complicated situation now. We have 3 partners, Lan, Mol, and Noose, L, M, and N. So they have capital balances as follows. They do have a formula now for sharing profit. So the first $20,000 is based on their investments. The next $20,000 is based on their service, which is spelled out as being shared equally by Lan and Noose, and then the remainder is divided 1/3, 1/3, 1/3 equally. Total net income for the year, $46,000. Okay, so let's see. The first $20,000 is allocated based on capital investments. Okay, so capital then for Lan, Mol, and Noose, $10,000. And this is the capital. $10,000, $15,000, $25,000 for a total of $50,000. So the share then, right, if this is based on a capital investment, the first $20,000, the share for Lan is going to be $10,000 divided by $50,000. Mol is $15,000 divided by 50, and Noose is 25 over 50 times this first 20,000. Means that Lan, that works out to $4,000. Mol gets $6,000 and Noose gets $10,000. Okay, so that's how the first 20,000 gets allocated. The next 20K is based on service, shared equally by Lan and Noose. So Mol presumably doesn't work in there. So Lan gets 10,000, Noose gets 10,000, 50-50. Okay, and then the remainder is divided by equally, and so that is the next 6,000 is 1/3, 1/3, 1/3. Okay, so then what does that look like? So we've got L, M, and N. The first 20 we said was 4,000, 6,000, 10,000. The next 20 was 10,000, nothing, and 10,000. And then finally 2,000, 2,000, and 2,000, right? So this is the first 20,000 here. This is the second 20,000 here. And here's the remaining 6,000. So each partner ends up with, not each partner, the first partner, Lan, ends up with 16,000. 8,000 for Mol, and 22,000 for Noose. And that is how we allocate the $46,000 worth of profit. Okay, so now let's look at how we go about accounting for the admission of a new partner. So a new partner comes in. So remember though, what we already said was that anytime a partner leaves or a new partner comes in, the old partnership dissolves. The old partnership dissolves, and a new one is created as long as there's more than one remaining owner, right? If there's a partnership of two and one leaves, it's not a new partnership, it's a sole proprietorship. Okay. So how can a new partner be admitted? Well, there's actually a number of different ways if you sort of think about it, right? A new partner can go to an old partner and just buy the interest, right? So, and from the partnership's perspective, really, not a whole lot changes. They have three partners, let's say. One of them sells to another, a new partner. So they still have three partners. It's a new partnership, right? Because the old partnership has dissolved, the new one's created. But from the business perspective, from the accounting perspective, all that happens is the equity, the capital, is merely transferred from one partner to another. So there's a cosmetic journal entry. There's no cash going through the partnership. The new partner buys from the old partner. No cash, no transaction coming through the new partnership. It's just a cosmetic, if you will, a cosmetic journal entry where you're debiting capital of the old partner, crediting capital of the new partner, and that's it. So that's kind of the real nub of that transaction is separate and outside the partnership itself. However, another way that a new partner can come in is to invest directly in the partnership. Okay, so they can bring in some cash or some assets, and the other partners agree to let them in. And so the old partnership's dissolved, a new agreement is created, and so on and so forth. And so the key question there is, okay, how much equity, how much capital in the partnership does the new partner receive? Do they get exactly the cash amount that they bring in, or do they receive a greater amount or a lesser amount of equity in the agreement, in the business? And it's quite possible that the business itself is now worth more than the book value of the equity that's in the business, right? Maybe they've started to make a bunch of money and all this other kind of stuff. And so if the business has $1 million in the bank, and the two existing partners have only got $20,000 each worth of capital, and a new partner comes in and says, well, here, I'm going to give you $20,000 capital. I want a third of the business. So for a $20,000 investment, they theoretically own a third of all the assets, including a third of that $1 million. That's a pretty good deal, right? So it's quite common that when a business is not at its first beginning starting out stage, that a partner can bring some money to the table, but the amount of capital they would get in the business is not equal to the amount that they actually invest, right? So at the end of the day, how do we account for that? Well, if the new partner contributes cash or anything else greater than their equity, meaning that the value of the business is higher than just the dollar value of the equity that's there, then the old partners would receive a bonus. You're paying more than the amount of capital that you're receiving as a new partner. That extra amount gets shared out by the old partners into their capital accounts. Likewise, maybe the business isn't doing so well. It's had some losses and stuff, and you're having to bring in a new partner, and they're actually getting a bigger share of the business than the amount that they're contributing asset-wise. Well, then the new partner kind of gets this bonus, if you will, and that bonus comes from the equity of the existing partner's account. So the bonus itself decreases the old partner's capital accounts, and that would be done based on the original profit and loss sharing ratio from the old partnership agreement. Okay, similarly, the withdrawal of a partner, it does, as we said, cause the old partnership to dissolve, and we have to account for the net income that has been earned in the year up until that point where the partner decides to leave, because they are entitled to a share of that up until that point in time. So we will do a partial year calculation on how much net income or loss has been done and allocate that out to each partner, right? And then we may also revalue the assets to, depending on, again, what the partnership agreement spells out as the formula for a partner leaving. They can, we would revalue the assets, allocate a gain or loss to the partners according to whatever formula is in the agreement, and that would go into their partnership accounts, or their capital accounts, and so on, and so on. So let's look at some different examples here. Okay, one partner. The simplest is just like a new partner buying the shares of an old partner with just that cosmetic journal entry on the books of the partnership. The partner can just sell his interest to an existing partner or to a new partner, and then they leave. So on the books of the partnership, all that we have is this cosmetic journal entry, right? It just transfers the equity. Debit the equity of the old partner, credit the capital of the new partner. Done. So no cash going into the partnership, nothing else. Okay. Now, on the other hand, a partner can simply withdraw from the partnership and take the assets with value exactly equal to their capital account and walk out. Now, maybe the assets get revalued, maybe they don't. Depends on the agreement and what the agreement says. But the withdrawing partner can get the exact amount of the updated capital balance. Okay. Or they can take, based on an agreement with either the partnership agreement or an agreement that gets kind of negotiated at the time of withdrawal. They can take out assets that are less than their capital balance, in which case the remaining partners share that capital that's left behind based on their profit and loss sharing ratios. And the new partner can withdraw and take more assets than what his or her capital balance is, in which case the loss of the kind of deficit there gets shared out among the remaining partners, again in accordance with their profit and loss sharing ratio. Now, we're not going to get into the nitty-gritty of doing the journal entries for partner coming in or withdrawing in this case. We just want you to kind of be aware of the fact that there's a little bit of accounting associated with this, and it can be a little bit tricky, but the key is follow the partnership agreement. And in order for that to be helpful, obviously, you got to have a partnership agreement that has sufficient detail in it to have to spell out for all these contingencies, how you share profit and loss, how you admit a new partner, what happens when a partner wants to leave, how the partnership gets dissolved. Do you revalue the assets before you figure out how much a withdrawing partner should get capitalized? What happens if a partner dies? Is each partner required to carry life insurance or should the partnership carry life insurance to pay out the shares of a partner? I mean, the stuff gets complicated. I mean, imagine if you've got 3 partners and they're all experts and specialists and they all work in this business. One of them dies and that share is inherited by the partner's wife. Well, maybe the wife doesn't have, or husband, maybe that husband doesn't have any of the expertise that the partner had, and the other partners don't necessarily want the wife or the husband to be their partner. So you'd want to think about how to deal with that. So maybe the partnership has to carry an amount of life insurance on each partner, and that life insurance pays the spouse of the partner, or essentially the life insurance in the agreement spells out that buys the shares of the dying partner from the estate. So the estate gets a whole big schwack of cash, but the partnership remains only with the surviving partners, right? So these are all things that you need to think about before starting a partnership. This isn't something you want to do with a handshake and a couple of notes scribbled on the back of a cigarette pack. Okay. So as we've just kind of discussed, the death of a partner also does dissolve a partnership, and you want to have this kind of thing spelled out in the partnership agreement. So this was a real quick and dirty overview of the nature of partnerships and accounting for them. This is all we're going to do in Chapter 12. It's not a hugely important topic that we're going to emphasize in this course, and so that concludes this lecture.